Good day, everyone, and thank you for joining our presentation. Our group will be analyzing Padini Holding Berhad, which is the company we selected for this financial reporting assignment. The purpose of our presentation is to assess Padini's financial performance over 4 financial years from 2021 to 2024 and determine whether Padini is a suitable investment based on its financial trends and overall stability. As required by the assignment, our analysis also includes a comparison with Mr. DIY Group M Berhad, which functions as the benchmark company. This comparison helps us understand how Padini is performing within the Malaysian retail industry, especially when facing similar economic conditions. In this presentation, we will explain Padini's key financial trend, compare them with the benchmark, and conclude with our investment recommendation supported by evidence from our analysis. This slide provides a brief overview of what our presentation will cover. Our evaluation focuses entirely on Padini's financial performance from 2021 to 2024. These 4 years represent an important period because Padini experienced both the recovery phase after COVID 19 as well as more recent cost pressures from inflation, labor cost increases, and rising operating expenses. Padini is analyzed across 5 major areas: financial performance, profitability, liquidity, efficiency, solvency, and shareholder value. These categories allow us to assess Padini's earning capability, operational stability, debt position, and overall value to investors. To provide additional insight, we compare Padini's trend with Mr. DIY, which is the required benchmark stated in the assignment. Since Mr. DIY operates in the same retail landscape, the comparison helps us interpret whether Padini is performing above, below, or in line with industry expectation. The main purpose of this presentation is to summarize Padini's strengths and weaknesses based on the data and determine whether it is an attractive investment opportunity. Next, I will explain how we conducted our analysis. We calculated all 15 required financial ratios for Padini covering profitability, liquidity, efficiency, solvency, and investor value. These ratios were then examined across the 4 year period to identify how Padini's performance changed over time and whether there were consistent patterns or fluctuations. We used a 4 year trend analysis to understand the direction of Padini financial performance rather than looking at each year individually. This approach allowed us to see whether Padini was improving, weakening, or remaining stable across different financial areas. As instructed by the assignment, we also compared Padini's trend with those of Mr. DIY. This, bre- this benchmark comparisons helps us contextualize Padini's result, especially in areas like profitability, inventory management, and financial risk. All our calculations were based on Padini's and Mr. DIY's published annual reports, and our interpretations considered the economic environment during these years, including inflation, demand, recovery, and change in operating costs. With this methodology, we are able to present a clear and comprehensive evaluation of Padini's financial position. I will now pass on the next speaker to discuss the detailed findings.
This slide highlights the overall profitability trends of Padini from 2021 to 2024. To begin with, Padini's profitability showed a clear improvement after the pandemic period. In 2021, the company recorded a net profit margin of 5.25%. This was a relatively modest figure, mainly because consumer spending was still recovering and operating conditions were challenging during that time. Moving into 2022 and 2023, we can see a strong rebound. Padini benefited from the full reopening of the economy, higher foot traffic in retail outlets, and stronger demand for apparel products. As a result, the net profit margin increased significantly, reaching 12.22% in 2023. This improvement reflects not only higher sales but also better cost absorption, meaning the company was able to spread its fixed costs more efficiently due to higher production and sales volumes. However, in 2024, the trend shifted slightly. Profitability declined as the company faced rising operating costs. This includes increases in wages, rental expenses, and utilities, a trend that many retailers in Malaysia also experienced due to inflationary pressures. Although these cost increases reduced Padini's profit margin compared to 2023, it is important to note that the 2024 profitability level still remains above the 2021 baseline. Overall, despite the slight downturn in 2024, Hardin's profitability performance from 2021 to 2024 shows that the company has returned strong earning capacity. The long-term trend demonstrates resilience, effective cost management during recovery years, and the ability to sustain profitability above pre-recovery levels. Next, we look at EPS and shareholder value. Between 2021 and 2023, EPS increased sharply from 8.22 cents to 33.85 cents, reflecting the growth in profitability. In 2024, EPS decreased to 22.28 cents due to margin pressure, but it still remains significantly higher than pre-pandemic levels. Overall, shareholder value increased across the 4 years. Padini does show more earnings volatility compared to MRDIY, which maintains steady results, but Padini offers stronger upside potential in favorable periods.
Platini's liquidity performance is one of its strongest areas. Throughout the 4 years, Platini's maintained very high liquidity, with carriage ratios consistently above 3 times. Even the quick ratio remained strong, showing that Platini can comfortably cover its short-term obligations even without relying on inventory compared to Mr. DIY, which maintains returns between 1.9 and 2.4 times. Patini clearly demonstrates stronger short-term financial stability. This reflects careful working capital management and strong cash generation. In terms of efficiency, Patini shows mixed results. Receivable conclusion remained consistently low between 13 to 17 days, because most transactions in fashion retail are immediate cash sales. However, inventory days fluctuate Patini performed well in 2020-2022 2022, but inventory increased significantly in 2023 before stabilizing at a slightly lower level in 2024. These fluctuations are normal for a fashion-based business where stock turnover depends heavily on trends and seasonal shifts. Mr. DIY showed more stable inventory patterns because its products are non-seasonal, less sensitive to demand cycles.
Padini's solvency position is stable and financially conservative. The company maintained a low debt-to-equity ratio throughout the 4 years, ranging from 0.59 to 0.68. This indicates that Padini relies less on debt and carries lower long-term financial risk. Interest coverage remained strong as well, peaking at nearly 15 times in 2023 and staying healthy even in 2024. Compared to Mr. DIY, which uses more leverage to fund store expansion, Padini maintains a safer financial structure. Here is the overall comparison with Mr. DIY. Padini performs strongly in high demand years and shows higher profit potential. Mr. DIY, on the other hand, offers more stable but less volatile performance. Padini's liquidity is significantly stronger, while Mr. DIY is more efficiency in inventory management due to the nature of its product. Solvency also favors Padini, which has lower gearing and stronger interest coverage. In summary, Padini provides higher upside potential but with more year-to-year variability, wherever Mr. DIY provides more stability with lower financial risk. To conclude, Padini demonstrated strong financial fundamentals overall. It maintains high liquidity, low leverage, and stable solvency. Profitability peaked in 2022 and 2023, and also margins declined in 2024. Performance still remained above the 2021 level, while earnings are more volatile than Mr. DIY. Padini's long-term potential and cash strength make it attractive for investors seeking growth with moderate risk. Therefore, our final recommend is a buy with a moderate risk and growth-oriented outlook. Thank you for listening to our presentation.